You can save and invest into a pension plan, and perhaps it's for your retirement income. And if you don't happen to use that pension for those purposes and you pass away, it means that that pension pot currently passes through to future generations free of inheritance tax. And it's been quite a nice financial planning strategy to transfer wealth through the generations free of inheritance tax. But as a result of Labour's first budget in 2024, that's all going to change from April 2027, when all pension pots, personal pensions, self-invested pension plans, any pension pots that you built up within a company pension, all of these pension pots are going to form part of your estate for inheritance tax purposes. And it's going to mean that for the average person, that inheritance tax isn't going to be a tax just for the wealthy. Remember, an individual person only gets £325,000 of assets that are free of inheritance tax, which is called the nil rate band. On top of that, you might get an extra £175,000 of assets on the house if you leave your house to your children. So that's only £500,000 for a married couple. That's double, because you can transfer those allowances on first death to the survivor. So that's £1 million, over which you have to pay 40%, or the beneficiaries have to pay 40% inheritance tax. That's not a huge amount of money anymore. You know, those thresholds have been fixed since 2009. They're going to be fixed for another few years, up to 2031 at least. And it means that, you know, in this part of Bristol, you know, homeowners, the average house price, you know, often takes up most, if not all, of that inheritance tax allowance. And with personal pensions, SIPs, pension assets forming part of your estate, it means that anyone in that situation now might come into the conversation for inheritance tax and needs to start reviewing your financial plans again. If you're a married couple with approaching $1 million or over $1 million already, you definitely need to start reviewing your financial planning. You need to start looking at your estate planning again to start taking advice. And for anyone looking to transfer assets, wealth through to future generations, children, grandchildren, you need to start sitting down and start taking advice. That inheritance tax needs to be paid 6 months after the date you've passed away, which is an incredibly short period of time, considering assets that might be subject to inheritance tax might be property or pensions from April 2027, you know, highly illiquid type assets. And if any unpaid inheritance tax after that 6 months gets charged interest at base rate plus 4%. So it's a very punitive interest rate on inheritance tax that's not paid. And with pensions now making that whole probate process a whole lot more complex, the government don't even know how it's going to work yet. They're consulting on how it's going to work. There's effectively going to be a parallel running of two processes. The usual probate through your estate, through your will, which is already horribly complex if inheritance tax is involved. Alongside that's going to be the pension process when you're dealing with different providers, potentially different pension providers. Who's going to have to pay the pension, when, how much, between the two different processes. I can see it being really complex. So it's really well worth, if you have pensions, revisiting all of this again to make things not only tax efficient from an inheritance tax point of view, but make things as simple as possible, you know, for your executors when the time comes. From an income tax point of view, if you're over 75, what we know is that if you inherit a pension, you're having to pay an income tax on that inherited pension. But now you might have to pay inheritance tax as well. So the effective tax rate when you combine the income tax and inheritance tax might be over 80% on those pension plans. So strongly recommend that you start looking at these pension plans as part of your overall strategy and start taking advice. We've only got another year till April 2027 when these rules start coming in. So start looking at these plans now and start taking action. You need to start rethinking how these pensions are going to be used, how are they going to be accessed and when, and if you need to access the pensions. Remember, advice in this area is completely flipped. You know, it used to be the case that you draw money down from pretty much anywhere else apart from your pension, and your pension was a last resort because you could effectively transfer it through inheritance tax free. That's completely changed. You know, we need to start looking at where you draw the money from in the most tax efficient way. If you still have your tax-free cash, especially if you're over 75, you need to start strongly thinking about taking your tax-free cash and doing something with it tax efficiently from an inheritance tax point of view. Even if you drew that money out of your pension and didn't do anything else, it would still be more tax efficient than leaving it on your pension. And even if you're under 75, it might be worth starting to look at these sorts of things. Review your pension nominations. The spousal exemption still exists, so you can still transfer your pension tax-free to your spouse, but you need to make sure your nominations, your expression of wish forms are right up to date to make sure that they're as tax efficient as possible. Remember that your pension doesn't go through the will process. That's a completely separate process. And also think about your gifting strategy, whether you're gifting outright to family members, whether you're using trust planning, whether you're gifting out of income. Some of these areas can get quite complex. The rules around this can get quite complex. So in order to make sure these gifts are effective for inheritance tax planning, and making sure the right people are getting the right money at the right time, I strongly recommend you start taking advice in this area. We are specialists in this area. I'm doing 3 events towards the end of the month. These events typically sell out, so strongly recommend that you reserve your place. Let me give you the details of the events. So we're doing one in Thornbury this time. So the Swan in Thornbury on Tuesday the 17th of March, 10:30 a.m. to 11:30 a.m. We're doing one at St Peter's Church in Henleaze, Wednesday the 18th of March, 2:30 p.m. to 3:30 p.m. and another one at Stoke Lodge in Stoke Bishop, Tuesday the 24th of March, 4:30 p.m. to 5:30 p.m. In order to book, you can telephone 0117 3636 212 or email us at community@haroldstevens.co.uk. Alternatively, just go onto the website haroldstevens.co.uk and get the information on the events there. So you'll have the opportunity to not only listen to me to some of the solutions and actions in a lot more detail. You'll also have the opportunity to ask me questions face to face about your own individual circumstances. So I hope to see you there. If not, thanks for joining today, and we'll see you again at the next video. All right, see you again. Bye.